You're listening to Investor Insights Decoded, the podcast where our hosts, Michael Grant and Julia Foster, break down the most impactful memos from the world of investing. Today, we'll be exploring Howard Marks's memo, Are You an Investor or a Speculator?, written on the 3rd of September, 1997. Let's dive into the timeless insights that continue to influence investors today. And if you're enjoying the content, don't forget to like, subscribe, and share your thoughts in the comments. Your support helps us bring more valuable insights to the investing community. Now, let's get started. Welcome back, everybody. Today we're doing a deep dive into investing and, I guess more specifically, figuring out if you're an investor or if you're a speculator.
Oh, interesting.
We'll be looking at a memo by Howard Marks.
A classic.
Yeah, Howard Marks, of course, is the co-founder of Oaktree Capital Management. And this memo that we're looking at is from September of 1997, so quite a while ago.
Yeah, that was right in the heart of the dot-com bubble.
Exactly.
So very interesting time.
Yeah, so this memo is called, Are You an Investor or a Speculator? And as we were just saying, it's from a time when the stock market was absolutely booming. And, a lot of the things that he talked about then seem very relevant to what we're seeing now.
Yeah, I think that's why Mark's memos are so popular. He's got this way of looking at the markets. It just seems to transcend specific time periods.
Yeah, he gets to those core ideas that are kind of always relevant.
Exactly.
So right off the bat, he starts with this idea that investment success isn't about the type of asset that you own.
Okay.
It's about the relationship between its price and its value.
Interesting.
So he's saying that no asset is inherently good or bad.
Right.
It all depends on what you pay for it.
Makes sense.
I feel like that's such a simple idea, but it's something that we often forget when we're caught up in the excitement of the market.
It's really easy to get caught up in the stories and the narratives around a particular asset, especially if everyone around you seems to be making money from it.
Totally.
But Marx is really emphasizing here the need to always come back to those fundamentals.
Yeah.
You always have to be asking yourself, am I paying a price that's justified by the underlying value of what I'm buying?
I think one of the things that I really like about this memo is that he brings up this analogy of a pendulum to describe market cycles.
Right.
So he says the market is swinging back and forth between these two extremes. Euphoria and overvaluation on the one hand.
Yeah.
And then pessimism and undervaluation on the other.
Which I guess makes sense if you think about human psychology and crowd behavior.
Right. It's like we go from, being super greedy to being super fearful. And it just keeps...
Yeah, it's like a cycle.
It's a cycle, yeah.
But the million-dollar question is how do you actually figure out where we are in that cycle?
Yeah. How can you tell where that pendulum is swinging? What are some of the signs?
Well, Marx points to a few things.
Okay.
First, you got to look at investor behavior. So, are people being driven by fear of missing out? FOMO.
Yeah.
Or are they actually being cautious and selective with their investments?
Yeah, that makes sense.
And then the second thing he says you have to look at is valuations.
Yeah.
So, are those valuations justified by some realistic expectation of future growth? Or are they just totally inflated by speculative fervor,
Right. So if everyone's throwing money at any deal that comes their way, maybe that's a sign that we're closer to that euphoria.
Exactly.
And if everyone is super skeptical and prices are really depressed, maybe that's a sign that we're...
Yeah, that we're swinging more towards the pessimism side.
Yeah. Okay, interesting.
And to kind of illustrate this, he takes us back to two very different periods.
Okay.
The first one is the Nifty 50 craze of the 1970s.
Oh, yeah, I've heard of that, yeah.
And then the second one is the distressed debt opportunities that were around in the 1990s.
So those are two very contrasting market environments.
Yeah, totally.
So tell me a little bit more about that Nifty 50 craze. What exactly happened there?
So basically you had this group of 50 blue chip stocks that became the absolute darlings of the market in the early 70s.
Okay.
And these were big, well-known companies with supposedly guaranteed growth.
Right.
So investors just piled in, right?
Yeah.
They believed that these companies were unstoppable and had huge potential, so they just kept driving those prices up to astronomical levels.
So it was just pure hype.
Yeah, pretty much.
And what happened?
Well, By the mid-'70s, the bubble burst.
Oh.
And a lot of those Nifty 50 darlings saw their stock prices absolutely plummet, like 70% or more in some cases. Yeah, it was a pretty harsh reminder that no company, no matter how great it is immune to market forces.
Right.
And even the most, beloved stocks can fall from grace if the price gets too far ahead of the fundamentals.
So it's a classic example of buying into hype.
Exactly.
And paying a price that's just completely disconnected from reality.
Yeah.
But then you contrast that with the 1990s.
Right, which was a totally different environment.
Yeah.
So in the 90s, you had this period marked by economic distress and widespread pessimism.
Okay.
And companies that were facing even minor difficulties were practically considered worthless by the market.
Oh, wow.
So you had this opportunity, right, for investors who specialized in distressed assets.
Okay.
They were able to come in and buy these assets at bargain prices.
Yeah.
Betting on their ability to turn things around.
So the pendulum had swung from irrational exuberance to...
Yeah, to excessive pessimism.
Wow, so it seems like that would be really risky, though, to buy...
Like a distressed asset. What if it really is worthless?
That's where the distinction between an investor and a speculator comes in.
Okay.
Marx actually borrows a definition from the economist John Maynard Keynes to explain this.
Okay.
So Keynes said that a speculator knowingly takes risks,
Okay.
while an investor may be unaware of the risks that they're taking.
Interesting.
So someone who's just piling into a hot stock just because everyone else is doing it,
Right.
they might actually be an unwitting investor,
Yeah.
even if they think they're being this savvy speculator.
That's a really interesting distinction.
Yeah, and what Marx is saying is that intelligent speculation, where you actually understand and accept the risks you're taking, can be a sound strategy.
Yeah.
Especially when everyone else is running scared and prices are depressed.
So it's about having that clear-eyed view of the situation.
Exactly.
And knowing what you're getting into and then making those calculated decisions.
Right.
And I think a great example of this is the story that he tells about the risky commercial paper. Oh, yeah, that's a good word.
So he talks about how Oaktree bought commercial paper of this company that was having some trouble. And they knew that it might not be repaid at maturity.
Right, so they were taking a calculated risk.
Right.
But betting on their ability to navigate that situation.
Right.
And maybe profit in other ways.
But then there was also this money market fund that bought the same commercial paper at full price when it was considered safe.
Yeah, they were just looking at the rating and not really thinking about the underlying fundamentals.
Yeah, and then of course that fund ended up selling the paper at a loss.
Big yikes.
Just to avoid reporting that to their investors.
I mean, that's a perfect example of how perceived risk can be just as powerful as actual risk.
Right.
The fundamentals of that commercial paper didn't really change.
Right.
But as soon as that company showed any signs of trouble, the market just panicked.
Everyone's focused on those short-term headlines instead of the underlying value. So all that being said, what was the market sentiment like back in 1997 when Marx wrote this memo?
Well, it was pretty frothy back then.
Frothy.
Yeah, kind of like what we were just talking about.
Yeah.
There was this widespread belief that the good times would just keep rolling forever.
Oh, like the market could just defy gravity.
Exactly, like there was no limit to how high stocks could go.
And people were thinking that because we had low inflation and stable interest rates.
Right, and Marx pushes back on that pretty hard in this memo.
Really?
He says that even in a benign macro environment like that, there's a right level for stock prices.
Okay.
And that level might be below what the market is currently pricing in.
So just because things are good in the economy doesn't mean that stocks are automatically a good buy.
Right, exactly.
I actually remember reading this one part in the memo that really stuck with me.
Oh, yeah.
He talks about this period at the start of the bull market in the 1980s where you could buy companies for less through the stock market than it would cost to build them from scratch.
Oh.
And that was what really fueled the whole leveraged buyout boom.
Oh, interesting.
But by 1997, things had totally flipped.
How so?
Companies were trading at these prices that no rational entrepreneur would ever pay to buy the entire business.
So it sounds like valuations had gotten way ahead of themselves.
Exactly. And it's a good reminder that just because something worked in the past doesn't mean it'll keep working forever.
Right. Past performance is not indicative of future returns, as they say.
Exactly. So if investors can't just rely on a good macro environment to keep the market going up, what should they be focusing on?
Marx says it's all about finding relative value.
Okay.
So even in a bull market, There are going to be some assets that are more attractively priced than others.
Okay, so give me an example.
Well, he points out that in 1997, small cap stocks were lagging behind large cap stocks by a historically wide margin.
So maybe that was like a potential opportunity.
Right, exactly. For investors who are willing to look beyond the hottest sectors.
So even when the overall market seems expensive, there might be these little pockets of value hiding in plain sight.
Exactly. You just got to know where to look.
But it's got to be so easy to get caught up in the hype, right? Especially when everyone around you seems to be making money.
Oh, yeah, for sure.
So are there any safeguards against that? Like how do you avoid getting swept up in all of that excitement?
One thing that Marx emphasizes is that unexpected events, what he calls surprises, are really what drive market movements.
Okay.
And we can't predict the surprises, of course.
Right. Nobody has a crystal ball.
But we can be prepared for them.
Okay, so how do we do that?
Well, he quotes Warren Buffett in this memo.
Oh, I love a good Buffett quote.
So Buffett said, "The less prudence with which others conduct their affairs, the greater the prudence with which we should conduct our own affairs."
Wow, I love that quote.
So basically, when everyone else is getting reckless, that's when we need to be extra disciplined.
It's such a simple idea, but it's so hard to do in practice.
That's
Because you just see everyone else making all this money and you think, oh, I'm missing out. I got to get in on that.
right. You get that FOMO.
Exactly.
And that's when you make the biggest mistakes.
So in 1997, how was Oaktree managing risk in that environment?
Well, Marx walks through some of their strategies in the memo.
Okay.
So they were focusing on things like undervalued convertible securities,
Okay.
high-quality, high-yield bonds, and distressed debt with really strong asset backing.
So basically a mix of strategies that offered some downside protection, but still had the potential for upside.
Right. It's about finding that balance, not
Right.
being too greedy, but also not being too afraid to miss out on opportunities.
Makes sense. And I think Marx also shares this analogy from another famous investor, Julian Robertson,
Oh, yeah. I love that analogy.
the Phoenician sea captain analogy.
Yeah, so Robertson compared fund managers to these ancient sea captains.
Okay.
And he said that they were incentivized to prioritize speed over safety.
Okay. How so?
Well, they got paid based on the value of the goods that they transported.
Mm-hmm.
So, faster ships meant more profits, at least in calm seas.
Yeah, that makes sense.
But then the storms inevitably hit,
Yeah.
and those flimsy, fast ships were the first to sink.
Oh, no.
Only the sturdy ships, the ones that were built for resilience, could survive those rough waters.
So it's like a metaphor for the investment world.
Exactly.
Yeah.
In a bull market, it's so tempting to chase those quick returns.
Yeah.
And you take on huge risks in the process.
But then when the market turns,
Yeah.
it's the disciplined investors, the ones who are focused on value and risk management,
Right?
who are best positioned to weather the storm.
Exactly. And Marx is making it clear that Oaktree, like those sturdy ships, is built for resilience.
They're willing to maybe sacrifice some gains in the short term to ensure their survival over the long term.
Right. It's that long-term perspective that really matters.
Okay, so we've talked about the dangers of market euphoria, the importance of relative value,
Yeah.
and the inevitability of surprises. But how do we actually apply all of this to our own investment decisions?
Well,
Yeah, I mean, some of what Marx was describing back in 97 sounds kind of eerily familiar to what we're seeing now.
oh, for sure. There are definitely some parallels.
Yeah, so what are some of the things that jump out at you?
Well, take the whole narrative around technology and innovation, for example.
Okay.
It feels very similar to the late 90s, right? We're seeing these incredible advancements in AI and biotech, all these different fields.
Yeah, and it creates this feeling that maybe valuations don't matter as much anymore.
Right. Like the old rules no longer apply.
Like we see these companies with crazy high valuations, even if their current earnings don't seem to justify it.
Yeah, because the market is basically betting on their future potential.
Right, but how can you be sure that that potential isn't already baked into the price?
Exactly. And that's the challenge.
Yeah.
And just like Marx was saying back in 97, we have to be careful about just assuming that recent trends will continue forever.
Right, so just because tech has been doing really well for the past few years
Right.
doesn't mean that it's going to continue to outperform forever.
Exactly. And we also have to remember that we're still in this environment with historically low interest rates,
Oh yeah, that's a good point.
which makes it easier for companies to borrow money and grow.
Right.
And it also makes it easier for investors to justify those higher valuations.
Yeah, because the cost of capital is so low.
Exactly.
But what happens when interest rates finally do start to rise?
That's a big risk, right?
Yeah.
Because higher interest rates can squeeze corporate profits, they can make it harder for companies to service their debt.
Yeah.
And it can also make bonds more attractive relative to stocks.
Oh, interesting.
So we could see a shift in capital away from stocks and into bonds.
Yeah, so it sounds like there are definitely some echoes of that euphoria that Marx was seeing back in 1997.
For sure.
But I guess the big question is, does that mean a crash is imminent?
Not necessarily.
Okay.
Remember, Marx isn't trying to predict crashes. He's all about understanding value
Right.
and managing risk.
And that's what's really important for investors today.
Yeah. Regardless of what happens in the market, those principles are always going to be relevant.
So what does it actually mean to be a disciplined investor in this kind of market? Like, what are some actionable takeaways that we can get from this memo?
Well, first of all, I think we need to be really honest with ourselves about the risks we're taking.
Okay.
Are we chasing hot stocks just because they're going up?
Right.
Or are we investing in companies with solid fundamentals and a clear path to profitability?
Yeah, I think it's really easy to get caught up in that momentum and excitement.
Yeah, for sure.
But we can't forget that price and value aren't always the same thing.
Absolutely. And we also have to accept that volatility and uncertainty are just part of the game.
Yeah, the market doesn't move in a straight line.
Right. Unexpected things happen all the time.
So how do we deal with that?
Well, having a diversified portfolio and a long-term investment horizon can definitely help.
Yeah, that makes sense.
Because it allows you to kind of ride out those inevitable storms.
Right.
And I think maybe most importantly, we need to remember that quote from Buffett.
Oh, yeah, about prudence.
Right. The less prudence other people are showing, the more prudent we need to be.
So when everyone else is getting greedy,
Yeah.
that's when we need to be fearful.
Exactly. And when everyone else is fearful, that might be a good time to start getting greedy.
It's about being contrarian,
Right.
thinking for yourself.
Yeah. Not letting the crowd dictate your decisions.
So as we wrap up this deep dive into Howard Marks, are you an investor or a speculator?
Yeah.
I think the big takeaway for me is that it's not about timing the market perfectly or avoiding every downturn.
Right.
It's about understanding value, managing risk intelligently,
Yeah.
and just having the discipline to stick to your principles,
Even when it's hard.
even when it's really hard.
Especially when it's hard.
Yeah. And especially when the market is tempting you to do otherwise.
Totally.
So it really comes down to knowing which game you're playing.
Right.
Are you an investor? Are you a speculator?
Yeah. And being aware of the implications of that.
The choice is yours.
But choose wisely.
And with that, we'll leave you with a final thought inspired by Marx's memo.
Okay.
The market offers opportunities for both investors and speculators, but it's crucial to know which hat you're wearing
For sure.
and to act accordingly.
Don't let the allure of easy money blind you to potential risks.
Words to live by.
Until next time.